Well, this is Tamiko Toland from Cannex, and I'm here today talking to Bobby Samuelson. And I have some questions that I really wanted to know more about for him. But Bobby, I'd like to ask you to introduce yourself and tell me what you're doing nowadays.
Yeah, sure. So thanks for having me. So what I'm doing now, I basically have two hats. One hat is the president of Life Innovators, which is an independent life insurance and annuity product development firm. And then the other hat that I wear is I write a newsletter, a technical newsletter for life insurance professionals just on life insurance product. It's called the Life Product Review. And then on the side, I give speaking engagements and, stuff like that. And prior to doing this, I was the head of product development and pricing for Bright House Financial for life insurance and annuities.
Great. That's actually, I hate to say it, this thing I'm most interested in quizzing you about is your history in managing products. In particular, I want to talk about annuities.
Sure.
And the thing I've been thinking about is, everybody complains, not everybody, but particularly folks more on the investment side of things, they always complain, oh, annuities are so expensive, right? And, it'd be great to talk about where the money actually goes for these very expensive products. And, we could start, actually, I think it'd probably talk about variable annuities because I think that's, as a product where there are actual fees taken out of it, as opposed to sort of implicit fees, it's a little bit easier for people to see, oh, these fees are going to something. What is that actually going into? So, I'll let you go ahead.
Yeah, well, first of all, I think it's a great question. And, I think back recently, maybe a couple of months ago, I bumped into the principal of a big RIA here in Charlotte. Actually, the RIA that I use, believe it or not. And one of the heads of the firm, I forget where I bumped into him, but he said, oh man, he said, I know you're in the life insurance and annuity business. He goes, you won't believe, he said, I saw this annuity recently, 3.5% fees, blah, 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 blah. Just goes in this whole thing, but you got to get rid of this. And the client doesn't understand it. And after he's kind of gone through his whole thing, I said, well, what kind of riders did it have on it? And he was like, well, what do you mean? And I said, well, yeah, it's got all these fees. Like, what are the benefits that you get for the fees? And his response was, he sort of looked like shocked and dismayed that I even asked the question, because to him, all he saw was the 3.5% fees, and he didn't really see the benefits. And so I think you're touching on a big issue in our business, which is, we kind of have we sort of have a large part of the investment world that's very focused on fees and has moved to a lot of passive strategies in an attempt to reduce fees in their investment portfolios for their clients. And you sort of have this incredible fee compression occurring on one side of the house. And then we have what looks like very kind of anachronistic products that don't really fit into that mold, that are, especially on the VA side, sort of very expensive relative to this. And if you come at them with the rubric of, oh, reducing fees is always better, you're not really going to understand them. And I've found that in talking to RIAs, that is unfortunately more common than it should be, where they just look at the fees and don't look at the benefits. And so where does the money go? I'll say it goes into all the logical places you would think that it goes. And so one of the first things that I talk about whenever I talk to an RIA about this is I say, well, what do you think the management fees are at the insurance company? What do you think is really their fee for the overhead, which is most comparable to kind of the fund management expense on a mutual fund? What do you think that number is? And you get ridiculous answers, 100 basis points, 200 basis points. That's not at all what's going on. And you can see this. So if you look at a fee-based variable annuity with no riders, what's the M&E fee? It's 25 basis points. And so you kind of look at it and you go, okay, look, carrier overhead is not 100 basis points. It's probably in the neighborhood of 25 to 50 basis points, which at the end of the day is actually pretty comparable to what you'd get in a mutual fund or an actively managed mutual fund or an ETF. So I think that's kind of point number one, is it's not like there's lots of carrier profit built in and all these overhead expenses. At the end of the day, these are actually, variable annuities are actually fairly efficient wrappers, and the insurance companies aren't necessarily charging exorbitant management fees for themselves that are out of whack with what you'd have in a normal mutual fund or ETF. So that's kind of one spot where I start is, okay, what do you think about carrier overhead? And then I kind of work down from there and I say, okay, let's talk about commissions. And of course, every RIA or investment professional says, oh my gosh, variable annuity commissions are so high. 6, 7%. Can you believe it? And I say, well, okay, but yeah, let's think about this, right? So the surrender charge period on this thing is 7 years. What would you have charged on managing money for 7 years? Well, I charge 1% a year. Okay, well, 1% times 7 years is 7%. So that's about the same as an annuity. It's just that, they pay it up front and then they defer it out over the 7 years. And they do that as part of the M&E charge, which is why on a typical B share annuity, the M&E isn't 25 basis points, 125 basis points, 135 basis points, or 140 basis points, somewhere around there. And so in a lot of ways, that's just commission recapture, which looks pretty similar to what the RIA would have charged for an investment management fee anyway. And so as you kind of work down the stack, you go, okay, so there's investment, kind of carrier overhead, there's commission repayments, and then we have rider-based benefits. And I think this is where there's probably the most confusion. Well, the first two are a lot of confusion too, but this one is hard to value because, investment professional who's not into annuities might say, oh, well, it's, 125 basis points or 150 basis points. That sure sounds like a lot. And so you can see the clear cost for the rider, but there's no commensurate sort of benefit calculation. There's no way to say, yes, but the intrinsic value of the rider is 175 basis points. And so actually the carrier is, based on your kind of economic projections, the carrier is actually undercharging you for the benefit. We don't do a good job as an industry of explaining the real power of the benefits. And so people just see the cost and they assume that the cost is exorbitant because they don't have a good way to mentally model the benefits. And in my experience running pricing, I would say, and I also just looking at a lot of carriers out there that have gotten out of this business or having to take huge write-downs in their variable annuity block, it's pretty hard to argue that those riders are underpriced. That are undercharged. Like the carrier's charging too much for that rider. They're charging too little for the rider. That's why they're taking all these write-downs. And so in a lot of ways, the value of the rider is greater than what the carrier is charging you for. It's just that a lot of people who are not in this business don't see it. So that's how I kind of think about where the money goes. And then the last piece is all the embedded fees and the funds inside the variable annuity, which sort of goes to subsidize a lot of different elements of the puzzle. But that's where the money really goes. And again, I think people generally just look at the high level, but don't really understand, because they don't understand where it goes. They don't see that it's not that this is some, the carrier is not being exorbitant in what they're charging. In a lot of ways, I think demonstrably the carrier is undercharging for the benefits they're providing. And that's the real power of the annuity in a lot of ways that I think goes missed by the public and their investment advisors.
So let's break down the fee for the rider. And, where does that money go? Because I think, people do, I've definitely heard, complaints, oh, these are expensive. And so you look at, how much does this thing cost? I mean, the reality is like for Cannex, we actually do calculate that, we calculate an actuarial present value. So it does give you an idea of the context of that as a benefit for the client. But, putting what we do aside,
right,
I think it'd be interesting to break down that fee because it goes towards explicit things. So can you go into that?
Yeah, it does. It does. And I think it's, here's the way that I think about it. And this may be different than the way you guys think about it, but the way that I always thought about it in pricing it was that when you really think about what the fee does, the fee is there to repay the capital posted by the insurance company to provide the rider. And when you think about how capital is calculated for a GLWB rider on a VA, it's based on the worst case scenario for the product. So we've got a situation where the carrier has to post up, 15, 20% of the initial premium deposit in capital to pay for the tail risk of the rider. Well, how does the carrier make its money back? Well, the carrier makes its money back, when people surrender and it releases the capital back, all right? Or when they take withdrawals, right, and it releases capital back. But also the fee goes to pay back the return on the capital. And so the way that I've always thought about it is the fee is there to essentially just repay the carrier for the capital. The capital is based on the worst case scenario. In the worst case scenario, the fee is not going to cover the losses because the fee is not going to be enough, right? The account value is going to draw down, the balances are going to drop, the fee is going to drop as well. And then all of a sudden now you have a situation where the carrier basically lost a bunch of money, all right? But on the good side of the house, in the better case scenarios, the carrier is going to make a lot of fee and not have to pay a lot out of its own pocket. The account balances are going to keep that policy in force, and the guarantee of the GLWB is not going to be activated. And so the fee to me is kind of a calibration mechanism to say, okay, across the spectrum of best case to worst case, how do we sort of calibrate a correct fee that doesn't drag on account values too much, but does pay us back for capital? And so that's where this kind of this constant balancing act of benefits in the GLWB versus the fee, you really have to balance those things out. You can't have a situation where you have so rich a GLWB and then bank on a very high fee to pay for it. Because if you do that, the very high fee will drag down the account values, which puts the rider more in the money, which makes it more expensive to the insurance company. So there's always this kind of balancing act there. And to me, the GLWB fees are really just a way to kind of calibrate that capital posting with the payback period and the expected account value performance across the spectrum of returns, recognizing in the worst case scenario, that capital is going to get called on and the fee is going to be, I don't want to say irrelevant, but a relatively small line item. It's not going to shore up the capital position. Whereas in the best case scenario, it's going to earn a nice return and you get these great returns for VAs with living benefits, which is why for a long time, carriers could basically they could offer very rich GLWBs and very high profitability, because in the median scenario, you get a lot of fees and you don't have to pay a lot of benefits. But again, that's because the worst case scenario is what you're holding capital to. And so that's the kind of always the dynamic that I've thought about. And so is it a good fee or a bad fee? I think of it as, look, it is a reasonable fee based on the potential outlying scenarios. And so in some ways, kind of like, it is what it is. And there are plenty of situations where the carrier undercharges on a fee and over provides a benefit because their view of the future is different than the client's view of the future. They're using a certain economic model to project out what they think is going to happen, but a client might have a totally different economic model in their mind, maybe a more pessimistic one, and that makes the rider look more valuable to the client, even if it might not look more valuable to the insurance company, and therefore undercharged relative to the intrinsic value. So that's kind of always the way I've thought about it.
So when you look at the profitability, it's like, especially for publicly traded companies, we have very much of a quarter by quarter view. But what you're actually saying is that the profitability of a product sold today is not really known until, that cohort has, lived until like whatever age. I mean, let's just say 105 is relatively safe, right?
Right.
But I mean, it seems like this is the risk that the insurance companies are taking on, right? I mean, that's the whole purpose of insurance.
Correct.
Yet I feel like that's not really well understood in the marketplace, certainly not by consumers, but really not by advisors either.
I think you're right. I think people say insurance companies take risk, and they're generally talking about mortality, morbidity, longevity risk, the kind of traditional insurance type risks. I agree with you. I think a lot of people miss the distinction that with both VAs with living benefits and with guaranteed UL on the life insurance side, insurance companies very much got into the financial risk game. And that's where like a GLWB is a great example. I mean, yes, there's a longevity component to a GLWB, absolutely. But the primary risk in a GLWB is not the longevity component. It's interest rates and it's equity returns. And that's it. And those two things are, in some ways, if you think about it, if you evaluate like an option, right? Imagine a Black-Scholes framework for valuation of that rider. What goes into a Black-Scholes calculation? It's volatility and its rates. And essentially, these are put options. These are very long-dated, longevity-based put options priced inside the product. And so if you get a lot of equity volatility, that increases the value of the put option. And if rates go down, that increases the value of the put option. And that is exactly what you see in VAs with living benefits. And to your point, in terms of profitability, a carrier's view of profitability, the view of profitability is going to change over time. But to your point, the actual profitability is going to materialize however it materializes. And what a carrier says today is not what is going to actually happen. What they're saying today is based on certain future assumptions that we know with 100% certainty are not going to come to pass. The only question is, how far afield are they? And that's what makes pricing these things really tricky. It's funny, I was talking to somebody about this one time, and they said, the thing about this is it is just like a put option, but it's a put option that never resets in price. So the carrier basically puts a 50-year put option on their balance sheet and never resets it. And so, normal market put options pricing changes all the time. With these, they set them up and they let them ride. And then you're stuck with the liability for 50 years or 30 years or 40 years or whatever the income period is. And that's the effect that you see on the balance sheet. And so of course they're all mispriced. The question is just how badly mispriced are they? And in what direction? So
it seems like that could be like a good marketing spin, for the very financially oriented folks, to reframe it in terms that they would understand. But it really seems like these products are it's much more of an alchemy process than a purely financial process, because it's also not like financial products, financial guarantees, where you're building it to be very precise and so that your obligation is completely covered by your instruments, which you obviously can do with a structured product.
Yeah. Yeah, and I think that is a big difference. Is with a structured product, you're right. It's bonds, it's options. The payoff is totally hedged. A lot of companies try to hedge VA, and if you look into the earnings reports for a lot of these companies, every company has a slightly different hedge strategy. And so at Bright House, we had a very unique hedge strategy, and a lot of it relates to earnings volatility. I mean, if you want to hedge a VA, you have to pay for it, but it reduces your earnings volatility. If you're willing to have more earnings volatility, then you don't have to pay for then you don't pay for the hedge, which means if things work out, you made a lot of money, you didn't spend all this money on these hedges you didn't need. If things don't work out, however, you're on the hook. And so what you see is a wide range of approaches to hedging. And a lot of that deals with accounting. US companies that are GAAP-based accounting look at it one way, stat-based another way, Canadian one way, European another way. I mean, so there's a lot of incentives that flow into kind of how you look at hedging these sorts of things. But to your point, it is always and forever an inexact science. There's no such thing as a perfect hedge, because if you think about it, it's a 50-year liability. You can't hedge 50 years on this product, on rates or on equities. So you always have some sort of a term disconnect, which creates obviously lots of different incentives to create lots of different hedging programs. And that's what companies do. So it is very much an inexact science for sure.
Yeah, I used to regularly read earnings reports, and one of the things that I paid a lot of attention to was that kind of philosophy about, are we hedging to accounting? Are we hedging for the actual obligation? Yep. And honestly, if I were a client and owned a contract, I would want you to hedge to the obligation. Right. But as a shareholder of the company, you want to hedge to the accounting. So it seems like there are these, you don't need to dive into this, but it just seems like there are these very conflicting interests out there. But it's important for people to understand that, it can create some differentiation in how companies handle the risk. Yep. And, these philosophies that are not necessarily directly related to even the issues of your, forward-looking assumptions and so forth, right?
Yeah. I think I would put it, even if I was talking to consumer, I'd put it even in a different way, which is to say, look, if these products did not have any intrinsic value, carriers would not feel the need to hedge them and charge these fees. The competitive market would drive that down to zero. So the evidence that these things are valuable, the evidence that these fees are worth paying, is embedded in the fact that carriers have to figure out how to hedge it. Because if there was no value, there would be nothing to hedge. And so clearly there's value in the contract. And like I said, I think that's the biggest thing that people miss, is they just look at the fees. They don't understand the value. And that is the public relations disaster that we've had for annuities, is that people think the fees don't go anywhere. But everywhere you look, you see evidence that these things are incredibly valuable. And like I said earlier, if anything, they were underpriced relative to the value as the market has unfolded. Carriers back in 2011 were not expecting interest rates to be where they are today. And that's just the fact of it. And so all those products were undervalued or underpriced. They should have had higher fees. They should have had lower benefits, and they didn't. And anybody who's got one should hang on to it. In fact, I'll tell you a quick funny story. My granddad is 90 years old, and he just got engaged to a 73-year-old lady. They're going to get married in January, which is awesome. And I'm super excited for him. But the funny thing is, she emailed me out of the blue and said, "Hey, I have this variable annuity the company's trying to buy back from me. Should I do it?" So I said, "Well, send me your policy." And I look over, and it's a GMIB, 6% roll up, no investment restrictions, all in 70 basis points for that. And yeah, and I said, "And you got to keep it." And she said, "Well, yeah, but the fees are, my advisor."
Oh no.
And I said, "And don't take the deal. If they're trying to buy it back from you, it's good. All right. So hang on to that variable annuity." And I won't name the company because I don't want them to get mad at me. Right. But I mean, this was a great deal for her. And she did not understand what she had owned. Her advisor who sold it to her didn't really explain how to use it. And so now, she's taking dollar for dollar withdrawals. She invested in way riskier stuff because she's got step ups on it. And she's going to use it for what it's worth. But before that, she just thought, I just have an expensive investment account. I don't really understand what I bought. And I think a lot of people are in her situation. I will tell you actually one other quick funny story on that too. I was on the beach maybe 5 years ago when I was still working at Bright House, and my kids were playing in the sand. I got talking to some guy on the beach, and he said, "Oh, who do you work for?" Whatever. I said, "Oh, work for MetLife, soon to be Bright House." He said, "Oh, I have some of your variable annuities." And I said, "Oh, what do you?" He said, "What do you have?" He said, "Oh, I've got the 2011, GMIB Max." And I said, "Well, we'd like for you to surrender that policy." And he goes, "Oh no, I'm keeping that policy forever." He goes, "That is a fantastic." So you never know, right? There are people that have no idea. And then this guy who was the CFO for a railroad company, he knew exactly what he bought and he knew exactly the power of it. And according to him, he was never letting it go. And so I think, he's got the real story, but a lot of consumers just don't understand what they bought. And it's our job, I think, to make sure clients understand what they're buying and the value of what they're paying for.
Yeah, they should know beforehand. I mean, they should really get that this is a thing that they're buying, that there is an actual guarantee, whatever format it is. And I do want to ask you about other annuity formats, but before I do, I want to talk about a word that you've used a couple of times, which is profit.
Yeah.
I feel like this is a dirty word. Like, people talk about, oh, well, the annuities companies are just profiting, whether it's, you get hit by the bus the day after you buy your immediate annuity, and then they get to profit on all that money.
Yeah.
Obviously we can get into that, but just the idea that these are companies that are, for some, do we have an expectation that insurance companies are not supposed to make money to pay the people who work there? And then, are you not supposed to be compensated for the risk? Like, everybody who has a job, like, you do the work and you expect to get something in return. And, that's the same thing for the company structure. I haven't seen evidence that insurance companies are wildly profitable. But, let's talk about profit.
Yeah. And profit is a weird term. So if I'm a sock manufacturer, I know what my profit is for every pair of socks that I sell. And it's probably pretty stable across the board, right? So I've got a certain margin and I sell a certain number of socks, I get a certain margin, and I know what that margin is. That's not the way life insurance and annuity works. So for every person who gets hit by a bus on a deferred, on a SPIA, right? Or every person who gets hit by a bus and the income payments stop, if it's life only, there's somebody who lives to 110. And so one person might feel like they got a raw end of a deal, but another person got the better end of the deal. And it's the insurance company's job to pool that risk and price it for the actuarial expected return. Now, to your point, okay, what's the right profit on that? Well, let's look even at corporate structures. So we have mutual companies where all the profits go back to the shareholders in the form of a dividend, or to the policyholders in the form of a dividend. So do we want policyholders to get dividends? Well, that technically means they were overcharged and then they got a refund. What about stock companies? Well, stock companies take capital from outside shareholders. The capital providers have to earn a return. And so, of course, you have to pay back a return on that. You've got nonprofit companies out there, TIAA-CREF, for example. How do they price? Well, it turns out they price pretty similarly even to other. So to your point, there's not a lot of profit flowing around the system. But I think people misunderstand the word profit in this context. At the end of the day, insurance companies have to pay overhead, of course, but that's a small piece of the puzzle. The profit really is repaying the capital provided to sell the contract to begin with. If you post capital, you've got to provide a return on capital to justify the transaction. And so if you want life insurance, you also have to be okay with someone making a profit, really paying a return on the capital in order to provide you that service, because it costs money to start the deal. This is not a free Robinhood account where Robinhood does not have to post any capital because you gave them money. This is an account where when you give the annuity company money, they have to post capital day one in order to justify selling you the contract, which means they have to earn a return on capital. And that's really the metric companies are gearing for, is return on capital, not so much profit in the way that if I was selling a sock, right? I get just a VIG on top. I'm really just paying returns on capital. And that's ultimately what it comes down to. So I don't think people really understand that, selling insurance, again, is not like selling socks. This is a product that is a capital product. It feeds on capital. That's the raw material to make it work. And in order for you to justify getting capital, you have to pay a return on capital. And if you can't do that, there's no reason for your business to exist. And there wouldn't be any life insurance and annuities. If you couldn't provide any return on capital, then that would not happen. And actually, honestly, That's one of the big threats right now, is if these products are showing negative returns on capital, or people can't get the right returns on capital, there won't be enough capital to flow into these products to provide capacity for our business. We have to find a way to provide returns on capital, or else it won't exist.
Great. Well, now I want to talk about the free annuities.
Oh, yes.
Yeah. Annuities that don't have explicit fees. And I got to tell you something funny is that I was speaking, it was for an RIA oriented event, and I mentioned this issue of like a difference between a variable annuity and a fixed annuity is implicit versus explicit fees.
Yep.
And somebody's like, what are you talking about? Like, well, wait, did you think that the fixed annuity is free? Like things are happening. There's not money coming out of your pocket, but there's still money. You just don't see it. So right. I think the invisibility of it to some extent is appealing, but to the other, if you really think about it, like, oh, well, how expensive is it? How profitable is that for the carrier? So I'd really love to, for you to dissect what happens with a fixed annuity. We can start with, your basic fixed annuities.
Yeah.
And maybe you want to break it down with SPIA and so forth, but let's go there.
Yeah. I think it's a great point, a great thing to highlight, because this is another big misunderstanding. And to your point, I hear it all the time. I hear people talk about free annuities or no fee annuities. It's like, no, it's no explicit fee annuities, so I'm with you. Now, SPIA is a little bit different animal, right? Because that's not really SPIA, it's all happening way behind the scenes. It's just a payout structure. So for just deferred annuities, the simplest way to think about it is, of course, deferred annuities have M&E charges, if you want to think of it that way, built into it. You just don't see it. It's basically the carrier's earning a rate, and then they subtract a fee to pay commissions and to pay their overhead, exactly like a VA. And then they gave you the net rate, and that's how it works. And so whenever somebody says to me it's free, I say, well, how do you think your commissions get paid? Like, what are you talking about? Obviously, it's the same thing. So, if you really look into the pricing, I mean, the M&E you see in a variable annuity is, I would argue, probably somewhat of a low end estimate of what you see as the embedded fees in an FIA, or really in an FIA. Fixed deferreds have lower comps, so a little bit lower fees, but like on an FIA versus a VA or even a structured annuity, a RILA, essentially imagine there's an M&E fee of 125 basis points baked into the back of the contract, and that's probably about right. I mean, it can kind of vary by company, 150, there's some that might even be 175, but there are always embedded fees back there. And so, yeah, I would say there's no such thing as a free lunch. There's no such thing as a free annuity. It's just that your rates are lower than they otherwise would be. And if you want to see evidence of that, then go to a company that has an advisory share FIA or an advisory share RILA and look at the rates between the free advisory share RILA and the free B share RILA. And you're going to get very different rates. Why are the different rates? Because there's an embedded fee baked into the B share to pay the comp that's not there for the advisory share. So yeah, I don't know how much more you want me to go into that, but like that is it blows my mind when people say that these things are free. Now I will say this, should they be done this way? What would be the preferable way to do it? And I would argue that for most people I can understand why advisors want them to be free, but I don't understand why consumers want them to be free, because there's no transparency and there's also no accountability. So if I was a client, I think what I would much rather have is higher rates with a declared fee so that I can compare the fees and the rates separately versus the net fees and the net rates. And I can and that way, if I could see the fees and the rates separately, I could kind of figure out, okay, is this a structurally cheaper product, or is this a company that has potentially a temporarily higher rate today, right? Or is there a company out there that has slightly lower rates but much lower fees? And so I think I think consumers, if they really could see both sides of the equation, would be better informed. Whereas today it's all mashed into one number, which is the rate being provided and kind of hidden behind the scenes, which to me removes a lot of transparency and therefore also removes some accountability. And, the last thing the annuity industry needs to be right now is more of a trust me product than it already is. So it would be much better if you just showed the client how it worked, rather than saying, oh, trust me, these rates, it's free annuity with these rates or whatever. Clients should really understand how it works and the fees actually being deducted behind the scenes. So
so you touched on this before, but let's go into this SPIA situation because again, this is one of those things where I find it frustrating that people worry so much about getting hit by a bus. I mean, for one thing, if you're hit by the bus, then you don't need to worry about what happens to that money.
Right.
In the first place. I know that's a little dark.
A little callous.
But there's a lot more balancing that goes on, and maybe, it would help people to understand how that works.
Yeah, well, and I should also say, I'm not a SPIA expert, but I think overall, again, you have to think of a SPIA as insurance. It's not an investment, it is insurance. It's longevity insurance. And to your point, and although you said it in kind of a callous way, which I like, because I like to do that too, if you got hit by a bus and you had bought an annuity, you weren't planning on getting hit by a bus. Okay, if you're planning on getting hit by a bus, don't buy an annuity because you're paying for insurance that you're never going to use. So the reality is for SPIAs that SPIAs are necessarily an insurance product, and there are events on the short end of that tail, and there are events on the long end of that tail. And if you're buying one, you have to understand that you're hedging the long tail and taking the risk on the short tail for you personally. You're buying a SPIA to prevent the problem of running out of money on a longevity side of the house, but potentially losing money if you die early. Now, that being said, I mean, look, if you're really worried about getting hit by a bus, go buy a life insurance policy. So go get a life insurance policy, take your payment and do a little bit of that. There's ways to manage that risk. The other thing is, SPIAs have period certain payouts. Some of them have death benefits. There's just other ways to sort of manage some of that risk. And I just think fundamentally, if your primary concern is I'm going to get hit by a bus tomorrow, then you might not be a great candidate for SPIAs. SPIAs are for people whose primary concern is I'm worried about outliving my money. And that's where they serve really well. And that's where this whole mortality credit concept comes in is, yeah, some people are going to die early, some people are going to die late. And SPIAs are really the big benefit of SPIAs are received by the people who live a long time, which is the whole purpose of the contract to begin with. So I don't know if that answers your question, but that's the way I've always kind of thought about it.
It does. You also, you talk about mortality credits, and it's funny because I was talking to somebody about this and how maybe mortality credit is, first of all, it's a term that most people don't understand, right. Even I'd say, in the advisory community. But also it sounds kind of bad, right? Mortality credit. So, what about like a survival bonus or a survival credit, right?
I like that.
Because that's the benefit is not to the people who die, it's to the people who live. And let's not focus on the fact that your friend had to die in order for you to get, I mean, these aren't tontines, but I think it'd be nice to turn that around a little bit, because then when you go back to getting hit by the bus, then the person getting hit by the bus actually benefits you, the survivor.
Right. That's right. It's sort of like life insurance versus death insurance. Right. The life insurance industry would have not gone so well if it called itself death insurance, but
exactly
life insurance. I mean, what could be bad about life? Yeah, it's so great. Life insurance. Well, yeah, you have to die to get it. But anyway, so I think there's probably some marketing mojo we could put into that for sure.
Well, it's funny, the life insurance industry, like life part of it, really, they got that. And somehow that got lost in the annuity world.
Yep.
So
You're
I don't know.
Right.
And it's very funny. So I guess generally speaking, are there any other pricing concepts that, you think would be important to talk about with people?
Pricing concepts. No, annuities are pretty simple and straightforward. I think what you guys are doing in terms of valuing GLWBs or income benefits in general is valuable work. And I wish more people would do that. I wish more firms would put more time and effort into that. And I'm concerned right now, if you look at the market right now, there's obviously a lot of attention going to RILAs. The traditional VA market is declining. VAs with living benefits is declining. Even some election rates on FIAs are down. You're kind of seeing this rise of accumulation type products. And I think that actually, I think there's some good things about that because tax deferral is a worthy, thing. And some of these index crediting methodologies, I think people really kind of jive with. But I worry that we are straying too far from the core benefit of an annuity, which really is income benefits. And I think it should always be an important piece of the puzzle. And it's kind of shame on us as an industry if we can't get people to see the value in a living benefit rider. Like shame on us. I mean, these are incredibly valuable, powerful tools. And I think as a pricing concept, people really understood kind of where the money went and the fact that you are getting what you're paying for and that you really are offloading a ton of risk onto the insurance company at a very reasonable price. My sense is that people would be more like my future, what would I call her, step grandmother, who says, wow, I had no idea what I bought, but now I see the power in this, and sends me a thank you email, every 6 months to say, hey, thanks for helping me out with this annuity. I just got my check. It's great, all this kind of stuff. So I think overall, just if people understood that they're getting fair value for their money, I think they'd be a lot more receptive to it. And like I said, shame on us for not being more transparent about our products to show people the power in what we do.
So it seems to me also that the low interest rates right now are such a huge challenge to product management that, even if we got our message right, and obviously there's always people who need income now or in the near
Right.
future, that it is kind of the time for these products that are really more just financial guarantees, the RILAs, to have their day.
Yep.
Are you concerned that that is too much of a distraction, or do you think that the pendulum is going to swing when, circumstances, meaning like in particular interest rates, make it easier for the carriers to support these products?
Yeah. So I think, let's go back and say, well, what's fair income out of an annuity product? Because theoretically you could offer guaranteed income in an annuity product in a 0% rate environment because of mortality credits. I mean, theoretically you could do that. So what's fair income? And so I think a little bit what we're dealing with right now is people having old expectations about what fair income is relative to what the market can handle today. And in the same way that we probably do look back on 2012 and 2011 and say, wow, those income benefits were incredible. If interest rates stay low, people may very well look back on right now in a few years and say, wow, those income benefits were absolutely incredible. And so I think what we've actually done is, rather than fighting the hard fight, which is saying, no, these are valuable benefits, even in a low rate environment, we sort of said, oh, I know it doesn't look as good as it used to. So here, go over here and sell my RILA product. Well, RILA is a totally different deal. RILA is an accumulation play, and RILA does work in a 0% rate environment, in part because carriers can price, because the put option has real risk. And I think one of the challenges of RILA in particular is people are taking a lot of risk and they don't realize how much the risk they're taking. And that risk is going to funnel the upside, but they don't but intrinsically they're saying, oh, 10% buffer, that's some protection, that's worth it. Well, the reason why you're getting so much benefit to the upside is because the risk is really high. And I think that hasn't been, that part of the equation, we haven't really seen that play out in the RILA market yet, but we will. And I think it's going to happen. And so I kind of look at that product and go, of course it has a place, of course it has a role, but so do income benefits. Like we can't let that story subtract from the income side of the house, which is really at the end of the day what makes annuities fundamentally unique. And not to pick on RILAs, but I mean, again, you brought up structured notes earlier. Look, which one's better, a RILA or a structured note? I think that's a good debate. And I think there are arguments to be made on both sides of the house. What I know is they are direct competitors. There is no direct competitor to an annuity. There is no substitute. There is no alternative. So no matter what way you cut it, what makes an annuity is the income benefits. And the further we stray away from that, I think the more dangerous, the more we tread on other financial instruments' turfs, the more we have to compete on their playing field. Let's compete on our playing field, which is guaranteed income.
So, it seems to me that part of the benefit of a GLWB, when you're deferring, which is, most of the case, and, obviously they're not even utilized like at a very high rate anyway. But the benefit is that, you have the optionality of this income, right? And yep. So there's that delay of like, well, I want a guarantee. I'm not really sure how I want to play that out. And I know that even before this COVID crisis, that carriers had been talking a lot more about a base accumulation guarantee. Because when you split those two pieces up, I mean, obviously there's a loss of benefit for the client. It's also less risk for the carrier. Like you say, like you're shortening that put,
right?
Basically, right? When you're doing that. But so if you disconnect that accumulation from the income piece of it,
yep.
It seemed like that was an idea that was getting stronger in the industry beforehand.
Yep.
So it seems like the RILA can play into that, obviously with the assumption of these risks that people may or may not fully understand. But is there a smoother way of getting from one product, from that accumulation piece to the income piece without being the same guarantee?
So you're basically saying, so firms are looking at kind of GMAB type designs, guaranteed accumulation, and you're sort of saying, well, how do you find the nexus between the income side and the accumulation side? And to your point, sort of maybe make it not quite as rich, but still provide some of that downside protection. Is that kind of where you're going with that?
Yeah.
Yeah. So I mean, there have been some interesting products out there that have kind of done this where, for example, they don't have roll-ups. They have a very simple, annual step up, a very low fee, and it's an income benefit, but it's not a really rich income benefit. And those products have been, I mean, there was a product at Fidelity that was really successful that we sold at MetLife. Very simple, very straightforward. And so to me, that's a very smooth way of doing it, where basically essentially kind of goes back to the old Hartford product with the GMAB, I'm sorry, the GMWB, where it is a return, but it's with a, kind of a fixed payment stream to pay back your principal. And I think there are some ideas, I kind of see that being where in a low rate environment, how you still offer some income guarantees that aren't as rich as what they are today, and sort of find that nexus between just giving you your money back and the income benefits without all the extra bells and whistles on it. So is that answering your question? Is that kind of where you were going?
It was, yes, because it was an answer. I mean, I'm just sort of fishing around because it's something I've been thinking about. Just like I say, that juncture, but I have to say the GMWB, it's not a lifetime guarantee.
Right. It's just
right.
paying
And so
back.
when those first came out, I was like, why are people buying this? It seems so dumb. Right. And then, then the GLWB, and then that kind of took off, and it's like, oh, okay, well, that makes more sense. I mean, I'm certainly not the arbiter of what makes a good product.
Right.
I just,
well, theoretically, a GMWB should be cheaper than a GMAB. And to me, that's the thing, is like, okay, theoretically, you should be able to charge less for that because it takes time to pay them back. Yeah. But in a low rate environment, how much less is it going to be? Not that much, because you don't have a big discount rate on the payments. So like, I don't know. We'll see. I think what I think is a little bit unfortunate is that companies are turning all of their product development attention to RILA, and they're sort of leaving VA with living benefit for dead, and they're not really putting as much heft over there. And that's too bad, because in the end, they're going to want a sustainable VA with living benefits chassis. And I feel like most of the investments going into RILA, and again, they should be looking at what will work on the VA with living benefits side. And the other thing that's just blown my mind is why companies have not put more living benefits onto RILAs. Like why, to me, that's part of the nexus. Is you have a defined payout structure. Everybody put managed vol funds in their VAs, trying to limit risk. And here you have the perfect risk limiting structure in a RILA. Why have you not combined these two things together? I mean, I'll tell you what, one reaction, at least I've heard, is I don't want to kill the golden goose. We've got a good thing going. I don't want to mess it up with a rider. Well, I don't know. That seems pretty myopic. So anyway, I think that's where part of that nexus is going to come in, is like, how do you get RILA? Maybe RILA will be the VA with living benefits chassis of the future, and it'll allow some really cool innovations there. So.
Well, and it's not like there aren't products, but it's not a big thing. I've been anticipating that would become a big thing for a while. And I certainly know of companies that have had concepts sitting on the shelf waiting to come out. So it's not, it's not like that isn't something that has been considered, but, hopefully they will turn that way. And, another thing I've been wondering about, so with variable income annuities, which feels a lot like a blast from the past, but I'm hearing some chatter out there. And, one of the things that it's made me think about is, well, why is it that these products didn't really take off when there was an expectation that it was like, it's literally why variable annuities were invented in the first place. And now they're, it's like their corpse is lying on the side of the road virtually. But now, I think we're going to start to see a little bit of Walking Dead situation, but there's been so much product development, right, that we've seen in other areas. And you look at RILA, like, well, can you marry the RILA with a variable income annuity? Like how, because the issue is the floor. Right. And they're great products, but they're super hard to plan around, because if you don't have a floor, you can't slot it in the same way as a SPIA. All right. And so I think that it creates a big planning challenge, and that, it's just one of those things. It's kind of like the advanced life deferred annuity. It's really hard to use. You can't use it on its own. You need to use it with other things. that's a little bit more of an extreme example, I think, but it certainly made me wonder, like, can we bring all of the tools to bear that we have today on these products that got stunted a while ago?
Yep.
So I'm curious, like, I don't know if you have any thoughts about that.
No, I think my overall thought would be, I think you're right. I think if you look at the history of the life insurance and annuity business, so sort of taking parts of one thing, combining it with something else, and then sort of reimagining it and combining something else. So I'd say that's kind of part A. And then part B is, there's a time and a place for everything. And if you look over on the life side at, for example, Lincoln Money Guard, that product sat on the shelf for many, 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 many years and didn't sell jack until interest rates went down. And all of a sudden it became really attractive. And so I'd say there's kind of a time and a place for everything. And, a great idea at a wrong time is going to look a lot like a bad idea. It's not a bad idea. It was a great idea. It's just the wrong time. And so I think in today's environment, there are some older ideas, to your point, laying around on the shelf that are going to get pulled off and are suddenly now kind of the right time for that conversation. And I think we're going to see a lot of that. I mean, I feel like in a 0% rate environment, companies are going to have to become very creative and they're going to have to dig deep. And I think there are some ideas laying around, especially ones that push more risk onto the consumer, that are going to suddenly have an attraction now that didn't before. But to your point, with guardrails, you can't just put all the risk on the consumer. You've got to find a way to kind of make that an attractive trade-off, whether realistically or just optically. But you've got to find a way to make it look like that.
Yeah, agreed. And I think, the thing with an IVA is, like I say, there's the nebulous part of it, or you lay guarantees on it, it just doesn't function quite as well. But you're covering the longevity risk.
Right.
And so this, again, like, we talk so much, and, me too, me particularly, about risk sharing, because this is like the concept that everybody's talking about right now to try to give a little bit more upside to clients. Like, let's hope that they get what they're selling on their end. But, anyway, so like, this is like torquing that risk sharing a little bit.
Yep.
Right. And because it's now you're not as much giving up like loss per se. It just may be variability.
Right.
It seems like there might be ways of modifying that. But if the thing that you're buying on the other thing and is the thing that you're saying, like, hey, RILAs don't cover this. Well, that's what this product does.
Yeah.
So
I think you're right. And there could be a time and a place for it. But also, I've also learned, I don't know if you feel this way too, we can think it's a great idea. And then you roll it out in the market and people don't understand it. They don't want to take the time. And it's like, you just never, there's so many great ideas in this business and so few successes. And so that's the challenge, I think. But you know what? I think companies more than ever are willing to try new things. That's my hope. And so pulling something like that off the shelf and trying it out, I think you're going to see at least a few companies try it. I can't imagine they won't.
Yeah, for sure. It's funny because, people talk a lot about contemporary tontines. I call them contemporary tontines so as not to be confused with, ancient tontines. But that's basically what a variable income annuity is.
Right.
Minus like one component that there you get the tontine. I'm like, well, if people are so excited about the tontine, like maybe they can get excited, hey, we got a thing that works and also works better for on an individual basis because you're not working with like a pool and so forth. And if you're not working with a pool, then basically you're pricing an immediate variable annuity.
I was about to say, and that is what it is at the end of the day. I mean, what's a mortality credit if not a tontine, basically? I mean, that's essentially.
Well, and the variable component, because you're investing in stuff.
Right, totally.
It's like, well, wait, it's all the things you were talking about. And we have a thing that does that.
Right. But whether or not people do it is a whole separate question. That's the challenge.
Yeah, I know. And I mean, so much of it, I think has to do with the planning application. I've been talking to some folks up in Canada because I've been doing more investigations into the Canadian market. And so they're basically they've legislated for QLACs in Canada. And so I've been talking to some of the folks up there. I'm like, it's not a standalone product. It's not a thing. It's not a thing that by itself.
Right.
It's like taking a piece of a car out of the car and saying, I've got this really great thing. Like, what the hell is that?
Right.
It's called a carburetor.
Right.
Right. it's really awesome. You want this card reader, but I don't understand how that works. Well,
Right. You got to put it inside the
it
card.
itself is very complicated.
Right.
And it works inside this other very complicated machine. And you really need to sell the whole car.
Yeah, exactly.
Right. And so, I mean,
QLEX.
this is the issue. I mean, QLEC in the US, it's right. It's just a wealth play. It's not being used as the thing that it is because it's basically non-functional
On its own.
without, yeah. And I feel like, and it's the same issue with the variable income annuity.
Yep.
Right. Because if you just have this thing on its own, like who's going to you don't just buy that. You don't just buy any annuity, but so, the more esoteric you get with these concepts,
right.
I think the harder it is to have them as freestanding things. And, it's like, oh, well, there's like half a statue for your house.
That's a really good point because that's a really good point. That's a really good point because you're right. You have to understand the whole package in order to get the power of it. You can't just see one piece of it and say, oh, this is what oh, great, I get to invest money, but I have an extra fee. Why would I do that? Well, it's because you get these other benefits, these income benefits, so, or, hey, I just want the income benefit. Well, no, you don't understand. If you want that, you have to have this other piece. But that's what makes our products hard, is there are multiple pieces of the puzzle. You don't have to understand a lot of things to go buy a mutual fund. You just go buy a mutual fund. And I think that's kind of where people just don't have the patience, to think through it. But I do think, you kind of keep going back to this variable income concept. Like, I think that there is something there too, because I think one of the things that's happened, at least since March, this is my sense and this is just me. I think carriers are a little bit less enthusiastic about being money managers than they were back in March. And I really do. Like, I think for a long time, it was sort of like, hey, we'll load up on all these esoteric risk classes and get all these CLOs and everything's going to be great. And then you get this, and we're going to make all this money and earn all this spread and there's going to be no problems. And, if you think about it, 30 years of a declining rate environment has put an incredible amount of unrealized capital gains on insurance company balance sheets. Like, it has been a very good time to be an investment manager in the US for, frankly, a very long time. Even through the financial crisis, it was okay. And now we're in March comes through and there's these incredible cracks in the market. And then in the aftermath, such low interest rates that everybody's piling into these assets to get yield. And so now you're taking a lot of risks to not get a lot of yield. I got to figure there's a lot of insurance companies out there who are like, you know what? Maybe I don't want to be an investment manager. Maybe I just want to do mortality longevity risk. And, and then earn a fee for wrapping these assets. Like, maybe that's really what I should get back to doing. And I just sort of feel like there's a little bit of that going on right now, which will be a boon to variable products, whatever form they take. Insurance companies are not good at taking risk, but clients are good at taking risk. And if that's the way you get return, then let the client take the risk. Don't make the insurance company take the risk and then try to pass it back to the client. So I think there's something there going on too, but I think time will tell. We'll have to see.
Yeah, and one of the problems with the investment risk, though, is whether you're talking about market risk or interest rates, whatever, it happens everybody at the same time.
Right.
It's not like people dying; they randomly die
totally.
here and there. It's like everybody dies.
It is not a law of large numbers risk.
Yeah, exactly. It's really, when you think about it that way, it seems like, oh wow, it's a very different nature, and it would be a good time to sort of recontemplate that.
So the way I've always talked about this is, for an insurance company, having lots of insurance policies diversifies your mortality risk and it exacerbates your financial risk. So basically, like, so the more policies you have, the less risk you have for mortality in terms of an outsized event. But if they're all the same type of policy, the more risk you have of an outsized event on the financial side. And to your point, I think a lot of people don't get that about insurance companies. If you've sold, a decade's worth of GLWBs, the chance that all of your clients, live forever is pretty unlikely. But the chance that the market goes down 30% and every single one of your policies goes down is like 100%. It's going to happen, and people don't. It's not a diversifiable risk unless you have offsetting policies, which I think is also another interesting angle. Is more and more companies saying, well, I have this stuff on my books. How do I sell a policy that offsets what I already have on the books? And if you think back to the original AXA SCS, Bright House Shield, those policies were designed to mitigate the risk of the GMIBs that were already on the books. And so I think there's a little bit of that going on too, where there's a lot of products out there that have certain financial aspects that, if carriers can sell opposite financial aspects, kind of going back to your example, a product that would not make any sense financially to sell on its own, but makes a lot of sense to sell in the context of a bigger block that behaves a certain way. I think we're going to see some of that too. which will sort of change the product development dynamic, because now you're building not for the economic environment today, but what you sold 10 years ago. And I think we're already seeing some of that. Like RILAs, I think a lot of the push into RILAs is to some degree a result of that. I mean, hot market, people are buying them, don't get me wrong, but like there's a natural attraction there that I think more and more companies are starting to play into.
Yeah, that makes a ton of sense. I just getting back to the variable income annuity thing and, not living on its own. The company that was most successful with that product was Fidelity, right? And the reason is because it packaged it.
Right.
It was the fixed and variable components together. I mean, it was still an income play in total, but it balanced it out. And I think about that a lot. When I think about this product line and like you say, balancing everything, and that's less about balancing out for the carrier. It's more about how the client is perceiving it. So there's like the part that's visible to them and the part that's not. Like you say, you're having, as an insurance company, you're having to manage all those risks and balancing them out. And I think the other thing that's very interesting about this, though, is the management of your book is very different from one company to another.
Oh yeah.
Right. And so the products that may be more attractive for you to offer are very different. And then that might create some value differences that externally are difficult for people to understand. I'm seeing the potential for additional communication gaps to appear. People, well, this company's charging a lot less. If they're charging less, then they must be getting less profit.
Right. Like,
right?
No, they just view the world differently or have different financial metrics or whatever. Yeah.
Yeah, I think it's good for more of these conversations to take place, for people to get that the management of an insurance company and of the products, it's really it's kind of, as you pointed out, it's more of a 4-dimensional exercise.
Yeah.
Right. And that, I don't think that people appreciate it. They just look at, oh, that VA is expensive and this fixed annuity is free.
Right.
Right.
No. Yeah. I think more transparency is better. And a lot of what this comes down to is we are just not very transparent as an industry. And what's think about going back to the original comment that I started off saying, we've got the entire investment management industry has moved towards lower fees and more transparency. Well, we don't want lower fees because lower fees means less benefits. We want benefits for our policyholders. That's what sets us apart. So how do you combat the perception problems that come from high fees? Be more transparent. And I think that's really where we've got to go, is more transparency, talk about the fees. And one of the big things that I always said at Bright House that I really feel strongly about is the carriers should not bake revenue share fees into their funds on their VA contracts and act like they're not there. I mean, when they go into clients and say, oh, you can invest in this fund and it's 55 basis points, and the reality is 35 of that 55 is being paid back to the insurance company, that's not okay. Like that is what gives us a bad name. It would be much better for you to charge a 25 basis point fee or 20 basis point fee and add an extra 35 bips to your M&E fee. Like that would be much more transparent. It would make much more sense to the consumer, and it would allow people to compare accurately. I think our big problem is just transparency. Everybody's trying to hide the ball. They're trying to make it look like we don't have fees. We don't want policies to not have fees. We want policies to have fees because fees correlate to benefits. We just do a bad job of explaining what these fees are and why they're there. If we did a better job of that, we wouldn't be so afraid of having those conversations. So yeah, that's my big thing. And I think to your point, like that's where this kind of fee versus free annuity comes in. Like that is no such thing. It's just that one's transparent and one's not. Or one's more transparent and one is zero transparency. That's the kind of problem we got to fix with transparency. So.
Yeah, I think that, having that conversation about the ball, you're saying like, don't hide the ball. Well, there is a ball there.
Right.
And it's okay to talk about it, whether the ball's inside, one product chassis or another. And I do understand the appeal of, you buy a fixed annuity where you know what your rate is. And, I'm not really disputing that as a structure, but just sort of, conceptually that it's not fundamentally different from a product where you do know how much it costs. But
Well,
Anyway,
no, but I think it's a fair point. So like a MIGA to me is a different animal. MIGA, the rate is the rate is the rate is the rate. It really doesn't matter, But then take an FIA where you get into an FIA and the rates are renewable every year. They're renewable every year. Well, MIGA is not renewable every year. So I agree. I don't care if MIGAs are transparent. Who cares? You get the rate, you get paid the rate. That's it. But on an FIA or even a classic fixed deferred where the rates can change every year, that's where transparency counts. If you've got a trust me issue, you must have transparency. And that's where I think it's important, really important, to do this on these free annuities, is to have more transparency. Not so much MIGAs, rates are rate. SPIA even, rates are rate. I don't think that's that important. There's not a lot of trust that goes into a MIGA or a SPIA, but there is a lot of trust that goes into a fixed deferred, indexed or non-indexed, and a RELA too, for that matter.
Yeah, that makes a ton of sense. Great. Well, thank you so much for chatting with me. But it's been a lot of fun and, very educational for me and hopefully for others.
Well, thanks for having me. I appreciate it.